Hello and welcome to this very special segment where we talk about market movement and also what should be your investment strategy. With me today is R. Shivakumar, Head Fixed Income Access Mutual Fund. Shivakumar, welcome to the show. And let's start with global triggers. And I want you to help our viewers understand the impact from the global banking crisis on India and Indian market.
Thanks, Kavita, first of all, for having me here. I think it's this banking issue which has been going on started in the US, let's say back in March, and also we saw one of the largest global banks based out of Switzerland go under. So we have it looks like a transatlantic banking issue. And we are reminded of the days of the global financial crisis. But actually, the issues are far removed from the crisis situation. What is really interesting is we have some bank failures, but no credit crisis. So let me phrase that again. We don't have a problem where these banks are having an issue with loans, defaults, etc. This is more a case of liquidity. As interest rates have risen, as liquidity has been withdrawn by global central banks, some of these banks are having challenges meeting liquidity. And that is where we have seen bank failures this time around. That's an easier problem for central banks to handle because central banks have the ability to create liquidity again. So if you look at what happened in Switzerland, or if you look at what happened in the US, these central banks intervene to add sufficient liquidity to those specific banks and were able to kind of underline the issue. And that's the reason we believe that this is not a large problem for us here in India. This is not an issue where we see a big spillover effect. And the limited spillover or the limited impact that it can have on us is more because it could have an impact on growth going forward.
What about the interest rate pause right now that we've taken? Do you think, or as per your analysis, the global scenario, if it goes in the direction of rising more interest rate, will also pressurize RBI to go for a rate hike, or you think the pause is likely to extend no matter the interest rate trajectory globally?
The RBI certainly seems to be on a pause mode. And in fact, global central banks also, especially the US Federal Reserve, also seems to be indicating that they would pause soon. Now, the reason for this is twofold. Reasons are twofold. One is that globally and in India, inflation is trending down. Here in India, we have had a situation for the last 3.5 years now, since December quarter 2019 to now. The average CPI inflation has been about 6%. And finally, last month, we saw a print below 5. And it's likely that inflation will remain below 5 for the very near term. And that will give RBI a lot of breathing room compared to the pressure that we've been under for the last 2 to 3 years. Even in the US, inflation is coming down. But I think the issue has shifted. The pressures have shifted away from inflation. I mean, it is not to say that inflation is not a concern. It is. But it has moved towards growth. And I think the fact that you have some of these bank failures puts some additional risk of growth globally. And therefore, global central banks will wait and watch in some sense to see if there is an impact, cascading impact on growth. And even from RBI perspective, if there's a global growth slowdown and there's, the talk of a US recession has been going on for several quarters now. But even if there isn't a recession and if there is a slowdown, the RBI will be very sensitive to that. So I think for the moment, rate hikes are reasonably off the table. And if we were to wait for rate cuts, probably a 6 to 12 month kind of a wait for rates to start coming down in India.
What about the bond yields? Do you think that they have started factoring low inflation already?
To some extent, yes. It's very interesting that we are here in month of May. And last year, month of May, June, we saw the 10-year in India peak out at 7.6%. And now we are at about 7%. So what has really happened is, despite the fact that over the last 12 months, we have seen significant rate increases by RBI, we've actually seen the bond yields moderate.